Welcome to this video called Performance Evaluation and Attribution, where we open up and begin the whole section of your Level 3 curriculum devoted to performance measurement. This is going to be an introductory video where we discuss certain concepts which will be explored in later videos in much more depth and detail. So the name or the phrase performance evaluation, which appears at least in the first segment of the title, is actually a bunch of, can be broken down into three distinct processes. And one of those is actually number 2 here on my list, is performance attribution. So attribution is an element of evaluation, which we will be looking at in this video, but also in subsequent videos in more detail. So let's begin with the first component of performance evaluation, namely measurement. Now, this may sound obvious, right? This may seem obvious. What does it mean to measure performance? Well, we typically identify this with the measurement of the return on an investment. We're talking about performance in a financial context. So in an investment context, we want to know what the investment return was, but that's not going to be the only element, don't worry. And of course, as you will know from your previous studies at level 1 and indeed at level 2, a return on an investment may be provided or measured in an absolute sense, so absolute return, or it could be stated as some kind of, for example, excess return, so the return above a benchmark typically, so that's going to be the difference relative in returns relative to some chosen benchmark, or perhaps a peer group, an average for a peer group, or indeed a specific competitor. However, as I said, measuring the return on investments is not the only aspect of or facet of performance measurement. Just as important, but sometimes perhaps somewhat overlooked or forgotten, is the need to measure the risk dimension as well. So the risk incurred just as much as the return. Of course, in order to achieve a certain level of return, we typically take on a certain amount of risk, and your book just says that the risk may be measured. Of course, incurred suggests that we're talking about risk that has already been incurred, so this suggests ex post measurement, so that means looking back in time. And when we do ex post measurement of risk, we often do so by calculating things like standard deviation, so measures of dispersion or variance, right, which is standard deviation squared, or indeed we just call it volatility. But remember from your previous studies that we often also think about risk in a forward-looking sense, and this is the ex ante estimation of risk. So looking forward in time, and one such forward-looking measure is, for example, variance value at risk, VAR, which you studied previously. Okay, so that's the first step in evaluation, measuring performance, understood to be both returns and risks. Then we come to performance attribution, but because this will essentially be the brunt of this video, I will only define it for now, and then we will have an opportunity to talk about it a little bit more in the next minutes. So explaining a very important word here, how the return performance was achieved. So that's one aspect. How exactly did we get these investment returns? But also, how did we get exposure to the risks? How the risks were incurred. But very important to emphasize is the word how here. We want to understand. And finally, appraisal, the third step, let's say, in evaluation. So we've got measurement, attribution, and then appraisal is all about evaluating the quality of performance. Now, what's the quality of performance? Surely you may think, okay, performance is either good or bad. It's either satisfactory or indeed not satisfactory. But what do we mean by quality here? This is another very important concept which we will be exploring in further videos. It's all about distinguishing between performance that was achieved due to the manager's skill versus just pure luck. Okay, and that's a very interesting aspect of the whole process, differentiating between those two. Now, let's focus on performance attribution. After all, the title of the video did sort of announce that we would be looking at this a little bit more closely. So your book begins with something that I've decided to show in a more sort of pre-written form. What basically are the features of an effective performance attribution process? What are we looking for? And I think most of these points are relatively straightforward. I don't think you need to write them down because you don't really need to memorize them. It's enough that you have them in the note. We're going to go through them and explain them. So let's start off with the fact that a good or effective performance attribution process should account for all of a portfolio's return, performance, stroke, risk exposure. So when you're trying to answer these questions, how much return did we achieve, or risk were we exposed to, did we incur, how were those achieved, how did we get the exposure, and whether this was due to skill on the part of the manager or luck, there shouldn't be any, let's say, elements of that performance which are left untouched. So the process should account for all of the portfolio's return or risk exposure, not just some of it. And we say, okay, the rest we don't know how it happened and whether this was due to skill or luck. So the process should be comprehensive. It should cover 100% of what happened. So the obvious consequence of not accounting for everything would be that your attribution process is simply incomplete. So over here on the right hand side I've got otherwise attribution is incomplete. Then the second point is that our process should also reflect how let's say the investment manager thinks and makes their decisions concerning the creation of the portfolio. And your book gives an example. It says, look, if you've got a manager who's, let's say, using this bottom-up process to constructing a portfolio, so they don't start at the top by thinking about sector weights and exposures, and then they drill down into the company level, but they start look at the company level, just looking for companies which they think of overvalued, irrespective, let's say, of industry. Then, that's absolutely one of the ways you can do things, right? This bottom-up process, but then ignoring, let's say, benchmark weights for sectors and industries, then you shouldn't, in the sense of performance attribution, apply a process that actually reflects a top-down approach and a top-down way of thinking. So starting with sector weights, it would just be very unnatural, and ultimately it would be of little value if your process for return performance attribution doesn't reflect the way the manager thinks. Right. The next bullet point here says quantifies that an effective process should quantify the active decisions of the portfolio manager. What do we mean by active decisions? Well, we want to, one of the things we said over here is we want to ultimately also be able to distinguish between skill and luck. And active decisions are the ones where the manager is going sort of thinking independently and doing certain things because they believe something is undervalued, or that a specific sector is going to perform well, and we want to be able to quantify that. Right, and we want a process. I think the last point is quite self-evident. We want a process which provides complete understanding of a portfolio's excess return or risk. So the return that was achieved above a benchmark, or the risk that was incurred above the risk that one would incur if we just followed passively a benchmark. So no need to memorize these things. I think just listening to me talk about them is enough. Don't try to force these into your head and brain. Right. Then the book discusses certain types of let's say performance attribution, but let's say that just like with measurement of performance, with attribution we've got these two facets. We've got return attribution and risk attribution. Remember how return performance was achieved and how risks were incurred. So in terms of return attribution, what are we looking for here? We're looking for an analysis. So we're trying to analyze the impact specifically of active investment or investment manager or management decisions on returns. Those active decisions, the ones where we were not just following passively, a chosen benchmark. With risk attribution is very much the same thing. So this one analyzes, or this is all about analyzing the impact of active investment decisions on the risk incurred. If we're going to have any chance of analyzing the impact of active decisions, we need to quantify those active decisions. We need to know what they were and what results they brought about. Now, this kind of analysis, so performance attribution, either on a risk front or a return front, it may be performed at different levels. So this could be done at the total fund level. Your book also calls this the total sponsor level, especially, for example, in the case of pension funds which have a sponsor. Total fund or sponsor level, and that's what we call macro attribution. Or it could be performed at a, let's say, more granular, lower level, the level of the individual portfolio manager. And no points for guessing this one. It's called, or it would be referred to as micro attribution as opposed to the macro level. Okay, and let's finish off with yet another way to segment, slice up, and define performance attribution into several types, but this time based on the inputs that we use. And as we discussed the three methods, returns-based, holdings-based, and transactions-based attribution, you will see that they become more and more sophisticated. The first method is the least sophisticated, it's most simple, but also least accurate of all three. So when you're doing returns-based attribution, and by the way, all of these terms will become more clear as we progress through the performance measurement and attribution section of the curriculum, because we will be building on these concepts throughout the next couple of videos. So returns-based attribution uses only total portfolio returns to perform the task of attribution only, right? What this means is that the analyst performing the attribution exercise doesn't even know what the portfolio holdings are. They know how the portfolio has behaved, let's say month to month, quarter to quarter, or with some other frequency, but they don't even know what's inside the portfolio. And this type of very limited approach will typically be used, well, out of necessity, because you can't do any better. It's used when we cannot obtain the portfolio holdings, so the contents of the portfolio, the components of the data on that. When portfolio holdings cannot be obtained, so we don't have insights into them with the required level of frequency. And if you think about, well, where would it be the case that I don't know what a manager holds in their portfolio? A lot of managers are very transparent about what they hold, but especially in the world of alternative investments like hedge funds, it's difficult to know what exactly is held in the portfolio of a hedge fund. So in the case of hedge funds, that may be a necessary type of attribution that we use because we lack better data. Now, there are, of course, some positives associated with this type of simple approach. It is the easiest method to implement. It's very, uses very light data, not much of it. But on the downside, but it's also, the least, so let me say, but, exclamation mark, it's the least accurate of the three methods. Fortunately, the next two will be increasingly more accurate. So holdings-based attribution, obviously it uses data on portfolio performance in terms of returns, but also uses beginning of period holdings. So this time we know what was in a portfolio, but we only know about the holdings at the beginning of a specific period. Now, that period could be a month, right? So in that case, we would have the opening data for a month or the closing data from the previous month concerning what was in the portfolio. Or it could be weekly. In fact, it could also be daily, right? So every day we know the components of the portfolio at the end of the day and therefore at the start of the new day. So that's a big improvement relative to what we had in returns-based attribution, where we didn't have info on portfolio holdings at all. Remember, attribution is all about analyzing the impact of active decisions in terms of getting insights into how performance was achieved or risks were incurred. So knowing what was held in a portfolio, at least from time to time, periodically, and being able to see what changed will be a huge improvement. And of course, as we go from monthly to weekly or daily data in that direction with higher frequency of the updates, our accuracy in terms of performing the attribution increases with let me write that again, with the period becoming shorter, with shorter periods. Okay. Whilst this method is better than an improvement on the previous one, on the previous approach, it still has a significant drawback. What is that? If you only know what's in a portfolio at the beginning of one day and at the beginning of another day or close of those days, and you try to attribute actual returns, so performance, to factors like portfolio holdings at the start of a day, you're still missing out on information or transactions that were conducted during the day. So the impact of transactions conducted during the period, and the period could be a month, it could be the week or the day, for which we only have beginning and closing data, that's ignored. It's like, ignoring the impact of any intraday trading, the sale, or we don't, if you sell some stocks from a portfolio, when did that sale happen? Did it happen at the beginning or at the end of the day, somewhere in the middle? You don't have that info. And obviously it does matter for total portfolio performance at what time a certain transaction was performed, during the day or during the week, or if you've got monthly data, even more so during the month, at what price. But we don't have that. We assume that all purchases and all changes in a portfolio's composition happened kind of at the end of the day or at the beginning of the day, and we don't take into account the fact that prices during the day varied. We only take the, let's say, end of day or beginning of day price to measure everything. So there's still going to be some element of performance that remains a bit of a mystery to solve. So it's not attributed properly, and this effect of trading throughout the day, buying and selling stuff throughout the day, leaves a certain residual in terms of the unexplained portion of performance, and the book says this is called the trading effect. Okay, now, whilst we have a method that provides the solution to this problem, let's also say that this strategy or this mechanism, holdings-based attribution, is not something you shouldn't consider, because it can be suitable in some cases. It's going to be most suitable, and this is the type of problem. This is the type of problem you may expect to have in the exam. Nobody will get you to actually, at least at this stage, perform these attributions, but recognize which method is best suited to what kind of circumstance. Like the first one, returns-based attribution, you would choose it as the method of choice, not necessarily the optimal method, but simply because you can't use the other two, which are better. Why? Because you don't have holdings data on it, with enough frequency. Here, this method would be most suitable for strategies that don't involve a lot of trading, right? Going in and out. So it's strategies with relatively little turnover. That's where this method or this approach is going to be, I guess, quite fine, because the residual will not be huge. Now, transactions-based attribution is sort of the pinnacle of the ladder. We won't get any better than this. It uses not just the returns, the holdings data that we had above, the beginning and end of a period, but also data concerning the transactions during the period. So the transactions that happen during the day, the week, the month, which is obviously me now suiting this to the different periods that we may actually encounter. The transactions, the prices at which they happened, but also the transaction costs. So, here it does matter that stocks were sold during the day at a certain hour or a certain timestamp, because the price at that point was so and so much. If you use holdings-based attribution, and you discover that one day a certain stock was held and the next day it wasn't held, you will typically assume that, yes, so it was sold, but at what price? You don't know at what price it was sold, so you'll, in your performance attribution, let's say process, you'll assume that the stocks were sold, for example, at the closing price, the price at which the stock exchange closed on a given day, which is not necessarily true in terms of reflecting reality. So here we're using all the information, and this is going to be a strategy that's optimal if you can actually use it. It's most accurate. It's going to be the most accurate of all the attribution methods. And the great thing about it is that it leaves nothing unexplained, right? So it leaves no residual at all, no residuals. The entire return, or if you want to excess return, depending on which type of return you're focusing on, may be explained, attributed to certain factors. So your clients, the investors, the sponsors will know everything about the returns that actually happened. Things will sum up here to the return that they see, with no sort of unexplained residual part. But of course, the downside of it is it's the most difficult one to implement. But if you've got a lot of fluctuation in the portfolio, a lot of trading happening during the day, and you don't want to have a big residual, this is the only method really to perform a comprehensive attribution exercise.